Now, there seems to be two camps out there, one for cryptocurrency, the other one for precious metals. And when I look at it, I believe one goes with the other. And I believe eventually what's going to happen is they're going to support each other as we move forward, as we move through the transition, as we get rid of the fiat central bank currency. It will all change. Now, the blockchain has the potential to revolutionize how gold and precious metals are manufactured and delivered. Consider the journey of a gold nugget and what it must go through, and the supply chain from when they mine it to the end consumer. It cuts through several other industries and practices, including legal, regulatory, financial, manufacturing, and retail, each of which might have its own ledger system. These ledgers are vulnerable to hacking, fraud, errors, misinterpretations. They can be forged, for example, to conceal how the metal or mineral was sourced. If they use blockchain technology to handle the mining of gold, there's no hiding anything. Remember, it's a ledger system, it's decentralized, it's a truth machine. Decentralization guarantees complete transparency, meaning anyone along the supply chain can see how, when, where the metal was produced and who was involved in every step of the way. So, blockchain technology can be used for precious metals, from when they mine it all the way to when it reaches the end consumer. And this will give the industry a huge shot of trust, not to mention dramatically increase efficiency. Now, many producers, tech firms, and entire jurisdictions have already adopted or plan to adopt blockchain technology for this very reason. We see IAMGOLD, a Toronto-based producer, announced last month that it partnered with Tradewin Markets, a fintech firm that uses blockchain technology to facilitate digital gold trading. And we can see that blockchain can be used for finance, healthcare, insurance, energy, and a lot more. And what we're seeing here is a merging of the blockchain technology with precious metals. And like I said in the beginning, I believe these are going to go hand in hand. And I believe the blockchain is going to be used for many different things, not just for currency trade, but for many other things, because it is a truth machine. You can always backtrack and find out what happened. Compared to today, that is very difficult, especially when you have a centralized system where maybe a central bank is controlling everything and there's no transparency whatsoever. You can't see their books, you can't see how everything is run, you can't see anything. And with this, it allows everyone to see everything. So we can see that this could be used for both and everything. And I believe this is where we're headed. And many individuals believe this is where we're headed. And I think eventually what's going to happen, this is going to take over everything. And those companies that were doing business one way, they're going to move slowly over to blockchain technology. Now, the economy is continually breaking down. Yes, we're going to be going through this transition. Yes, we have new technologies. Yes, we're going to be moving away from the central bank eventually. I think when the people start to wake up and realize that the central banks, the corporate media, have been demonizing blockchain cryptocurrencies, and they start to realize what it is as more corporations use it, people then are going to say, whoa, wait a minute, why are we using a central bank? Why are we using a banking system that has fraud, that has corruption? Why are we using a central bank that has no transparency? But right now, the economy is slowly dying. And the central bankers, they've been doing everything possible to keep the economy propped up. And we know a little bit what they've been doing. We know that they've been using quantitative easing. We know that they control the stock market. We know they've been creating bubbles. But a lot of the work behind the scenes that they've been doing, we just don't know. And I'm sure it's quite a bit. This is why they don't want anyone to audit what they're doing. But we see in the economy more and more stores, they're closing down. And this is the first sign of how the economy starts to break apart. You start to see it in retail. You started to see it in restaurants. You started to see it in housing. You see it everywhere where the people are transacting business every single day. This is where it breaks down first, and then it spreads to the stock market and everywhere else. And of course, the stock market is usually when everyone goes, oh my God, it came down. There must be something wrong. No, there's been something wrong for quite a while, just that no one really noticed it. Sears right now, they're closing about 40 stores, including 31 stores and 9 Kmarts. And the closing of the stores spans 24 states, including Arizona, California, Florida, Missouri, Ohio, and Minnesota. And they're closing a lot of stores. They're having a lot of troubles, just like JCPenney and many of the other stores. And once again, they're saying, well, this has to do with online and everything like that. And if it truly was online, we would see everyone taking their purchases and purchasing these items online. And we would see online business doing much, much better than it is today. I mean, it's doing well. And of course, it's going to gain ground as time goes on, especially when we start introducing cryptocurrencies and other payment methods. It's going to really skyrocket. But again, you're dealing with physical products. You still have to get the physical products to the people. And still, people like to go to the stores and get their physical products. They don't want to wait for them. Yes, delivery is getting a little bit better, but once again, it's still physical. It still takes a day or two to get your merchandise. But we're seeing many other stores, they're hurt by what is happening in the economy. We see Victoria's Secrets and Pink. This is owned by L Brands, and they've been struggling with growth. And they're saying this has nothing to do with the retail apocalypse. This has nothing to do with that. They've reached the top of their growth chart, and everything is not going well for the stores. They don't know what to do. And I think what's happening is people are not purchasing like they used to, and they're holding back now, and they're saying, you know something, we're not going to go out and purchase. We have a lot of credit card debt. We're not going to use our cash, and you know what, I can do without. This is what a lot of people start to do when they lose their jobs, and they get a part-time job, when they're not making the same salary as they were. They cut back, and this is what we've been seeing. We're seeing the consumer cut back on their purchases. This is why retail is really hurting right now. We see that the U.S. is shackled by a huge amount of debt. Now, the U.S. government reached a new milestone when our country topped $21 trillion for the first time. The national debt right now grows by an average of $17,000 every second, more than some people earn an entire year. That's only an average, and during the past 8 months, the national debt grew by $52,000 per second, and the trend toward bigger and higher spending is only getting worse, and it's not getting better. The ratio of national debt to GDP is 105%, larger than the economy as a whole. If we go back to 1981, the national debt comprised of a mere 31% of GDP. We are not moving in the right direction right now. And the Treasury Department has plans to borrow another $1 trillion this year, an 84% jump from last year. And when it comes to interest rates, well, we need to look at LIBOR, the benchmark interest rates used by leading banks around the globe. The LIBOR rate is intrinsically tied to government debt, and the U.S. has approximately $7.5 trillion in LIBOR-related debt alone. Individual loan debts are 97% LIBOR-related. 50% of the corporate debt is tied to LIBOR. As interest rates rise, it will hurt individuals, corporations. They will file Chapter 11 bankruptcies, and we can see that they have increased to 7-year highs. And the LIBOR rate is continually moving up. And as that moves up, it's going to get worse and worse for the individual, for corporations, and for governments. And we see right now that the foreign buyers of treasury bonds has been decreasing. Foreign buyers currently hold about 40% of U.S. bonds or debt. This is at a new low since November of 2016. Foreign investors have been on a downward trend since its high of 55% in 2008. The combination of reduced foreign demand and the need for increased funding could spell a disaster for the U.S. economy. And we see that the central bank, they're getting ready to raise interest rates once again here in the United States. The LIBOR rate is rising very, very quickly. And this is a complete and utter disaster. But this is the trajectory that we're headed in. This is being pushed in that direction to actually crash the central banking system. Everyone needs to understand that this is not a people-driven system. This is a system that the central banks created and convinced us over the many, many, many years that this is a great system. We don't need to be in this system. This is their system where they enslave us, where we have to pay taxes because we borrow the money with interest attached. They convinced us over the many years to believe that this is normal, that when debt rises, everything's great. You're prosperous when debt rises. And that's why the corporate media is out there always telling you, well, a lot of people spent a lot of money and put it on their credit cards. Debt is rising. That's good for the economy. No, it's not. As we can see in other countries, it's terrible for the economy. Yes, spending is good, but not debt spending. Because you spend that money, then you owe money with interest attached, and guess what? You can't pay it. So this is a complete and utter disaster for the United States, for Canada, Australia, Europe, for all the private Western Central Bank countries. It cannot be sustained. It's impossible. So how do you get out of this system? Well, you can have all the states vote and say we do not want the central bank anymore. You can go through the Congress. They can vote, but do you think they're going to vote in that way? At this point, no. The corporate media, the government officials, they're intertwined into the central banking system. This is why the central banking system has lasted for such a long time. How else can you get rid of it? Well, you can crash their system and then say we have to restart it. And say, since it crashed, we need to find out what the central bank has been doing all this time. Let's maybe audit them. Remember, they're taking care of the country. We should know what they're doing. It's that simple. And the only way out right now is to crash it. And this is why it's being pushed to the edge. And it will continually be pushed to the edge. Now, the central banks, they know their system can't last that much longer. They understand their system has a lifespan of 40 to 45 years. Maybe they can stretch it a little bit longer, but that's it. And they know once the debt level reaches a certain point and interest rates rise, it's game over. As you can see, the whole system's breaking down. People are living in an illusion right now if they think this system is going to last forever. It doesn't. Go back throughout history. It's been the same system. It's been the central banking system. There's been pockets when we didn't have the central bank, the private Western Central Bank, I should say. But if you go back throughout time, you can see that their system, when they're in control, it doesn't last. And we see that the European banks right now, they are in trouble. And there is one problem for the euro that keeps on growing. That's the unresolved banking crisis in Europe. And it's not a small problem. The euro system and Eurobank's balance sheet total around 30 trillion euros in January 2018. That is about 291% of GDP. European banks are in trouble for several reasons. First, banking regulation has become tighter after the financial crisis. Second, there are risks hidden in banks' balance sheets. Third, low interest rates have contributed to increased asset prices. Stocks and bond prices have increased due to the monetary policy of the ECB, thereby leading to accounting profits for banks. Monetary policy has thereby artificially propped up banking profits during the last years. 4, according to the ECB, non-performing loans where borrowers have fallen behind in their payments amount to 759 billion euros. That is 30% of the bank's equity. When the interest rates increase in the future, banks will be confronted with several difficulties. And we see with the LIBOR, with the Fed continually increasing rates, they're going to be faced with this. Non-performing loans will increase and zombie companies will go bust. Banks' long-term low interest rate loans will become more difficult to refinance profitably. Asset prices will fall, leading to losses. Governments may get into trouble, which they will. This will then spread to other banks. Remember, the derivatives are all tied into the entire system. As a result of all this, of all these losses, banks will be forced to restrict credits as their equity shrinks. This is where we get into the credit crisis. This is a no-win situation. Central bankers understand this. Why do you think they've been keeping the interest rates so low? It's not because, they want to benefit the everyday person. They want to make it easier for the everyday person. No, they're keeping their system together long enough where they can move it to a new system, but they want it to be controlled. It won't look like it's controlled, but they're really controlling it. And they're going to make it seem like someone else caused this. It wasn't them. Everything was going fine, and this is how they create the illusion where they say everything is fine, we've been doing our job, and then all of a sudden, these people did this, or this country did that, or the president with his policies did this, but it had nothing to do with the central bank. And on the other hand, the Patriots, Trump, they're pushing this economy to the edge of the earth, and they're going to push it over and crash it. And they're going to try to gain the narrative. Go back to 1971. Who had the narrative back then? We're running out of oil. You can't get oil right now. There's speculators in the market trying to get gold. So we're going to have to come off the gold standard. This was the central bank. They created an entire narrative to convince you of why you needed to follow along with what they wanted to do. It's going to be the same thing right now, but we have two sides. Who is going to tell the story? Central banks, where they'll say they blame it on someone else because we're going to a new system and this is why the entire system's crashing, or is it going to be the Patriots saying it was the central bank, we need to audit them? And this is where we are right now. But no matter what, we're going to be going through a transition. This is why you need to be prepared and ready